Financial accounting, liabilities, Chapter 11, bonds payable. This is predominantly about long-term liabilities. We talked about current liabilities in Chapter 10. In this chapter, we're going to be talking about bonds and the bond market, and we will be discussing a lot of terminology about bonds, so this is where the recommendation is that each student keep a vocabulary list with definitions because it definitely helps to understand the rest of the chapter. We will talk about accounting for bonds payable and not just the initial recording, but how one amortizes material. And as you can see from this goofy little cartoon that I found, there is a lot of information about bonds, and the concept is about interest rates going up and going down and what happens with the yield and the price of the bond. So we're going to be talking about the primary market of bonds, what happens when a company issues bonds and how do they record that on their financial statements. But when you start looking in the Wall Street Journal or looking at the bond market as a whole, that's the secondary market of bonds. That means these bonds have been issued and the individuals that have bought the bonds are turning around and selling them, either because they want the money out or because maybe the bond price value has gone up and they would like to cash out at a profit. So a little complicated, just be prepared with lots of good notes. So some advantages, first of all, there's advantages of long-term debt as well as stock. So one of the advantages of issuing stock to raise money for a company is that you don't have to pay common stock back. So let's take an example of a company that wants to expand and build a new factory and they need cash. They can either go borrow the money from the bank and have maybe a mortgage, as we talked about in the last chapter. They could sell bonds, but they could also issue more stock. And in this scenario, they won't have to pay the stock back. The stockholders are taking the risk, and they don't have to pay a dividend. However, if they decide that they're going to issue debt, such as a bond or a loan from the bank, they don't have to worry about stockholder control because there's no stockholders to deal with whenever you issue debt. You just have to deal with the creditors, which would be the bankers or the bondholders. There's also a tax advantage to issuing debt. Debt pays interest expense. It is required. It's not optional, but it's tax deductible. If a company issues stock, first of all, dividends are optional, but dividends are not deductible as an expense on the corporate tax return. So there's a lot of decisions that go on with a company when they make a decision about how to get the money to expand, because normally they don't have this kind of cash just sitting around in their bank account idle. So let's talk about financial leverage. This is one of those examples of a topic that's not in your text, but that is important for you to understand. Financial leverage means earning more from the money you raise from long-term debt than paying interest on the debt. So that increases earnings. So let's say that, for example, a company takes out a $100,000 loan to buy some new equipment, and they have to pay 4% interest on the loan, but they turn around and they find that they can save an equivalent of 6% interest on $100,000 in savings because this piece of equipment has made them more efficient and more profitable. That's called using financial leverage. And there is such a thing as negative financial leverage where it doesn't pay off for you to borrow the money. And there's always a financial risk, and we consider this to be risk versus return, very similar to individuals investing in the stock market. The more risky you are willing to be, the higher the likelihood that you'll get a return that's strong. But if you're going for low risk, you're probably going to have a less strong return on the investment that you have. So financial leverage is an important finance and business and accounting concept. I hope you discuss this in your BADM 101 course. So a bond is a type of debt. It's both long and short term because part of the bond could possibly be due within a year or less, but for the most part it's long term. And there it has a face amount. That's a new term for us. It's the face amount. It's how much is guaranteed to be repaid at the maturity date. So there's going to be a maturity date that shows when the bond is due. And the bond pays periodic interest. We'll talk about that. Just like anytime anyone borrows money or loans money out, there's interest involved. The bondholders are creditors of the company, and they have claims on the company's assets, and they will receive a payout before the shareholders. That's always a scenario with the bondholders. Liabilities always trump common stock or stockholders' equity because the creditors get their money before the stockholders do. So let's look at some terminology. Bonds are normally divided into a number of individual bonds, and the face amount is called the principal. And we're going to be talking about bonds in multiples of $1,000 each. Sometimes one person will buy 30 of these. Sometimes one person will just buy one. Sometimes a corporate investor or maybe a retirement fund will go in and buy a big batch of these bonds totaling millions of dollars. The bonds have to be repaid on the date the bond matures, the full $1,000. So regardless of how much the bond sells for, this $1,000 is going to be returned to the bondholder. The interest is paid annually, semi-annually, or quarterly, but we're going to be talking about semi-annual interest in our textbook introductory course. And there's a contract, and it's called the bond indenture. So what happens is the board of directors meet and decide with the finance team and the accounting team that they need to get some extra cash, or they need cash, essentially, to expand or to buy up another company or whatever. And if they make a choice of selling bonds to get their cash in, then they will have a contract drawn up. And this contract will have terms, show the principal amount, and show the amount of interest that the bondholders will be receiving, as well as the date. There are term bonds and serial bonds. A term bond has to be repaid at the end of a term. So it might be a 5-year bond, and at the end of 5 years, the company that issued the bond has to give the bondholders all of their money back. A serial bond matures in a series. So maybe it's a bond that part of it matures in 5 years, and another part matures in 12 years, and another part matures in 15 years. Generally, the longer the term of the bond, the higher the interest is going to be. Not necessarily always the case, but lots of times the terms of the bond determine the amount of interest that's going to be paid out. There are also some more complicated structures. There are convertible bonds that can be converted into stock. And so if the bondholder chooses, they can trade off their bonds for their stock at a certain rate determined in the contract. There are also callable bonds. That means that the company can decide that they've got the cash to pay off the bond, and they can call the bond. Usually they'll give the bondholders an extra amount of cash on top of the $1,000 back if they call it early. Okay, again, please take notes on this and pencil and paper to help with the best retention of this information before we get into the detailed debits and credits and accounting. So when a company issues a bond, there's going to be a face amount, an interest rate on the bond, and a maturity date. Okay, so we've got face, maturity, and interest. But there's also a market rate for similar bonds. So this information up here, the board of directors has met and decided face, maturity date, whether it's a serial or a term bond, and the interest rate, how frequently the bonds are going to be paid. So it's time to issue the bonds. Now, we don't go through this in this course, but generally there's someone on Wall Street or there's some big financial institution that will issue the bonds. And when they do so, they look at the market interest rate of very similar bonds, and that's going to decide whether the bonds are sold at a premium or a discount. So the interest rate on the face of the bond in the contract, in the bond indenture, is called the contract rate or the coupon rate. I have to give a little history about the term coupon rate. Before the internet, before we had everything electronic, individuals that bought bonds bought them at their bank, and they pulled a coupon out of a coupon book. Literally, it was a little slip of paper, and they took it to the bank, and the bank gave them their interest semi-annually. That's why it's called a coupon rate. That's the contract rate, and it's the amount guaranteed on the face. So if you have a $1,000 bond that has an interest rate of 6%, then that $1,000 bond is going to pay $60 a year or $30 every 6 months if it's a semi-annual bond payment. And that's the contract rate. Now, sometimes, frequently we should say, the market rate of interest is different. It's also called the effective rate of interest. And that's going to affect what happens whenever we issue our bonds. And they are called bond issuances. That means that we've sold the bonds, essentially. So when we compare the market rate, which is what's going on within the bond markets for the day, you'll hear that sometimes on the Wall Street Journal News. We compare this with the contract rate, which is the rate on the bond indenture, then we can decide whether the bond is going to sell for more than $1,000, and if so, that's a premium. Less than $1,000, that's considered a discount, or face. Face is the full $1,000. Might want to pause here, make sure you've got those three ideas down. Face, premium, discount. So if the market rate is greater than the contract rate, then the bond purchasers say, I don't want something that pays a poor interest rate compared to other bonds, and so therefore I will give you less than $1,000 for it. And that's whenever the selling price is less than the face amount. So that bond might be selling at only $980. Now, ideally, if the bond is paying 6% and all other bonds are paying 6%, then the contract rate matches and is equal to the market rate, then the selling price and the face amount will be the same, and the company will receive $1,000 from the bondholders. Finally, a premium. This is whenever the contract rate that the bondholders have offered, the company has said we will pay 6%, but the market is less. Every other company similar to this is paying 5%. That means that the bondholders that are purchasing will say, well, this is a good deal, but they're going to have to pay a premium. And so that means that the bond is going to sell for greater than face, greater than $1,000, and it makes sense. So let's stop for a minute and talk about how this might look if you were buying a car. Or no, let's just think about tickets to a concert. If the going rate of the concert is what's on the face of the ticket, then you'll pay face amount. If the concert is not very strong, it's not a popular concert to go to, you might be able to grab it at a discount. That's less than what's on the ticket. If the concert is a really good, strong concert, then you might have to pay more, and that would be selling at a premium. And so this just makes sense for the way the markets run. And of course, we're in the business world, so it all makes sense for us in that way. Okay, so the price of the bond is quoted as a percentage. So let's come down here to start. A bond sold at face is at $100 or $1,000. A $1,000 bond quoted at $98, well, you should immediately go, well, they're only going to get $980 for a $1,000 bond that they have to repay $1,000 to the bondholders. They must have had a bad interest rate compared to other bonds. Similarly, if you see a bond quoted at above 100, in this example it's 109, that means the bond is selling at a premium of $90 for $1,090. So I always tell students to stop and think about this. Yes, the company is excited that they received a premium of $90, but then again, they are paying a higher interest rate than other bonds. In this scenario, yes, the company's kind of disappointed that they got shorted $20 whenever they sold this $1,000 bond, but their interest rate isn't very strong compared to others. Down here, everything's equal. So understand again, this is why it's important to understand that a bond is a contract. Just like the price on a ticket to a concert, they're not going to change the price. You know, it'd be great if the concert, if the person that, let's say if it's somebody, a band playing in a concert, if they could anticipate that they could sell their tickets for a really high price, but they can't, so they just set the price that they think would be reasonable, and then the market turns around and plays games with it. That price is a contract price, and that's what we're dealing with here. The bond's base price is their contract price, and these are the three scenarios that we have. So if you have any questions about this area, I would suggest you go back and listen to this 15-minute video again. If not, you're ready to move on to part 2 of 3.